talk about valuation.
Well, hello everybody. Welcome back. Episode 80 today of the Pickers Market.
Can't believe
So
it.
we have a little anniversary.
That is
80.
amazing. That's a big number.
That's pretty good.
Yeah.
Today, Keith, Kyle, and Lisa are back in the room talking some very interesting topics today. And we teased our listeners last week.
That's right. You dropped the tease last
Yes.
week.
Forgot about that.
So we will bust out the bubble talk a little bit today.
That must have been what the commentary was about. Maybe
Yeah.
those listeners really followed
Right.
up.
So hopefully we teased enough that we get some listeners, all the listeners back and some more. So that would be great. Anyways, we start traditionally with two truths and a lie, and I thought because we talk about AI bubbles and valuations and all of that fun stuff that's in the news and getting more and more out there, we have an AI edition on Two Truths and a Lie. So let's get started. A. Sophia is the first robot who received legal personhood in 2017. B. The first ever AI chatbot named Alyssa was created in 1985. Or C. Some hospitals are using AI to predict when patients will die with an astounding 90% accuracy. Let's start with Kyle today because I
Yeah.
always pick on Keith.
Pretty sure B is correct. Eliza, pretty sure that's accurate. I could see C being correct, but I could also see it not being because you'd monkeyed with the accuracy numbers. Because hospitals are totally using AI right now. And AI is a very vague term. I mean...
But in this specific case, for specifically, you know.
Yeah. So what I mean is AI is a vague term, meaning, are we typing it into ChatGPT and being like, hey, when's this person dying? Or
the patient's
AI
records, give me a predictability.
Well,
on
no.
death back.
AI historically has meant machine learning or, like a reduction in the RMSE of like a scatter plot of outcomes.
Don't make it too complicated.
So
Our listeners might start falling asleep pretty soon.
yeah. So
He's going way down a rabbit hole on this one.
yeah. So I'm going to say A is not correct because I think that would have gotten a little bit more
News.
news.
So A.
Yeah.
Keith.
Yeah, these are good. I do think B is true.
Only
even
because
though-
he's riding my coattails.
No. I think because
okay.
it's I don't know if it was called a chat bot back then. It was probably called something else. And then just because Kyle's smart remark there, I'm going C is the
Is the lie.
is the lie because it sounds like that's if you feed a bunch of data through the machines at hospitals, that seems reasonable. But for some reason, I think you're trying to trick us on that one. So I'm going C is the lie.
Okay. Well, I guess that's the win for the morning for me. I got you both.
Again? Really?
Yes.
Eliza was not the first one?
So the lie is B. Eliza was the first chatbot. That's right.
The date she screwed us on.
1964,
Dang
not
it.
1985.
64.
So way earlier than that, even 20.
That was not called a
something.
chat bot back then, though, I assume.
It was kind of, so it was not
A
ChatGPT,
version. No,
obviously.
I
It
know,
was
but it
way
wasn't a
like
chat.
more
Bot, it's a
machine
recursive
learning,
loop. What is your
kinda
name? Eliza.
pattern recognition and something like that. But that was
All right.
Oh,
The
all
date.
officially said the first
Okay,
chatbot.
interesting.
Sophia was actually the first robot who received personhood in 2017 in Saudi Arabia.
Oh.
That is true. And C, not all hospitals, but some are using specific AI who can sift through patient records.
That's what I would assume. They're feeding
And-
records of your
right.
patients.
And when they're already kind of sick or whatever, they can predict, hey, how long is, the lifespan lasting? How high is the probability of a sudden heart attack or something like that? And it's pretty accurate, actually. It's pretty frightening.
What happened to Sophia? Is she still rolling?
I don't know if she's still around, but
They didn't throw that clanker into the junkyard or anything?
I mean,
She's still rocking and rolling?
2017, she's 8 years old now for a robot. That's
Okay, yeah.
phew,
Is that old or
That's
is that young?
that's I guess.
Imagine
that's
your
old.
iPhone from 8 years
Yeah.
ago.
Yeah,
That
that's
thing
true.
doesn't even work anymore.
She probably is not holding her passport any longer.
I do think that hospital thing's interesting.
Yeah,
That's
it
where
is.
we haven't talked much on healthcare and AI.
Yeah.
I think that's a very
Yeah.
area that's under
And what actually is going
served,
on there,
appreciated.
and
I think that could help a lot of things.
Mm-hmm.
Side note.
And also, I mean, it sounds like pretty scary, right? But hospitals are using it for treatment.
If you know something.
And they could, like, there were some studies, and not all of them are using it broad based, but hospitals that were using it, there were some studies on it that they can actually prevent, I don't know the percentage, but a good chunk percentage of death because of that, because
Makes
they
sense.
started treatment earlier or
A different
correct
treatment or more
right,
aggressive
yeah.
or
So it kind of helps maybe avoiding that death. So anyway,
Write that
let's
down.
back to Sophia.
back to Sophia. So back to the main topic of today, which is our hot button topic, and we hear a lot about that in the last couple of weeks. It got even louder. We heard it the last couple of years, right? The tech earnings are extended, valuations are high. AI, is it really doing the thing that everyone thinks it's doing? I mean, nobody knows yet, but is it really that groundbreaking? And over the last couple of weeks, like the talks about, are we actually in a bubble? And it's becoming a little bit unreasonable. It's getting louder and louder. And even some of the big names kind of joined the discussion and raised some concerns, which is Sam Altman from OpenAI, Ray Dalio, Jeff Bezos, Jamie Dimon, Michael Burry, the OG bubble boy. That was the
OG
latest.
bubble boy. I like
OG
that.
bubble boy.
What's his license plate? I bet.
Bubble. So anyway, those are, the big names. And there was a summit in Hong Kong, I think, over the weekend, where a lot of the Wall Street big bank CEOs also raised concerns that we can see a drawdown, valuations are high, it's becoming a little bit extended, and maybe it's I don't know, time will tell, nobody knows. But and one specific CEO, which is Morgan Stanley, and he talked about a potential 10 to 20% drawdown in equity markets sometime the next 12 to 24 months. So the question I have for you, though, is that's a long time frame. And I mean, that's not something unusual to begin with. That doesn't mean it needs to be a bubble. We just had a 19% correction early in April, and look where we are now. So, I mean, it's possible in that time frame, but is this really so alarming that they're all crying in uniformity at the moment? Because it usually happens even or despite the long-term bull thesis not completely falling apart. So, question is, do you think it's a little bit overblown that they are all starting to complain about that at the same time and the same, but still very, very broad based, right? At 10 to 20% in the next 12 to 24 months. That's kind of,
Yeah,
well,
I'll
who
start
knows?
with that comment. I think it's kind of that made me chuckle a little bit. It's like 10 to 20%. That's normal. So I would say that's very high probability. I mean, you're probably talking above 70, 80% in the next 2 years that we at least have a 10% correction. Corrections are normal. They almost happen every year. So he's stating out 2 years, like, okay.
That's the same with the recession talks, right? There are
Yes.
people out there who call for a recession for the last 3 years, but now it's really going to happen. It's like, well, if you believe it long enough, at some point you will be right.
Recessions do happen, and pullbacks do happen, and corrections do happen. So I don't think that's going on a limb. I think it's your bigger question of all these people kind of coming out recently.
Yeah,
I think
right.
is valid. I mean, we've talked about the market's been strong the last 2 years. This year's it's strong. We're probably due just from a timing perspective of some kind of correction and pullback. And then I think the bubble question we talked about, I think offline a couple different times and ways, is bubbles can last a long time, and they don't necessarily have to pop. They can just slowly deflate. I do think some stocks are definitely way ahead of themselves on valuation, and I think CapEx were kind of in that near peaking. I do think Meta's quarter last kind of was a my first sign, and it was like, whoa, there actually was increasing spending in the stock.
They doubled down again.
Their
Yeah.
stock reacted poorly,
Mhm.
which for the last year and a half, when you actually increase your capex on AI, regardless of the revenue outcome, it was, who cares?
Mhm.
Stock went up.
Mhm.
This one, I think that was, for me, that was a sign that be careful, make sure you're
Mhm.
buying stuff you like. I think these companies are all, generally speaking, are good companies, is what you're paying for them.
Mhm.
So be careful on valuation. I think is moving higher up my list, where we always say valuation doesn't matter as much as other things. I think it now, if you start slowing in capex, there's signs I think that you need to be careful and
Mhm.
kind of, for me, I'm probably underweight some of these names now
Mhm.
versus being overweight, and kind of that's, I still want to be involved as a group as a whole, but definitely pick your spots.
Yep.
Hmm.
And Kyle, maybe for you a question. And we had some big tech earnings last week, and we talked about that in the pod before they actually reported. Amazon, Meta, Microsoft, Apple, Google. So the question is, and Keith already mentioned that there were some differences in how they how investors reacted. I think Google and Amazon came out as the clear winners.
Mhm.
Like had reactions over 10% after their earnings, after they knocked it out of the ballpark. Meta was not disappointing, but they again doubled down on their capex spending, and now it's like, well, investors are getting a little bit iffy. So my question is, does that sound like we are still reasonable, right? Because bubbles, generally speaking, there's a lot of speculation going on. Investors getting unreasonable. Everyone just buys no matter what. Does that speak for itself that there's still enough reason in the markets that what we saw with big cap tech earnings last week, the different reaction of investors?
Yeah, I mean, you think about valuations. Everybody's pointing to like Palantir yesterday.
Mhm.
Even though quarter looked fine, it was just at 200 times current earnings. It's not cheap.
Mhm.
So you look at the space for the Mag 7, and you've got a similar dynamic, not to that extreme, but definitely stretched. The counterpoint to that is earnings exist, and it's not like the tech bubble in 2001 where it was just multiple expansion and no earnings to back it up. The breadth question was a little different between then and now, but it makes sense that people are nervous and jittery. I mean, you look at some of the benchmark weightings, and it's like, what are we at now? A couple podcasts ago, 40% plus.
40% top 10, yeah.
I mean, that's really,
That's a little scary.
It's pretty scary. So I saw an interesting chart though on that in terms of concentration, which kind of links hand in hand with the valuations. There was a market concentration bar chart that I saw that went back to like the 1970s when the Nifty 50 were rocking and rolling. And GE also had a huge percentage weight in the index. It was over 10% position.
It was? Well,
It was.
Interesting.
Wow.
I was really surprised by it. I should send it around. But because I didn't realize, I wasn't alive at that point in time. But, I wasn't doing markets, that's for sure. Looking at it to be like, oh, like this is like history rhymes. It doesn't repeat. So, yeah, I think people are probably correct to be cautious, even with earnings and everything, fundamentals to back it up. All it takes is, one kind of tail event to happen, like we saw in April with Liberation Day, to just suck the air out of the room.
Mhm.
So I could see that happening. And if you're over your skis on a 10% position in the benchmark, I mean, it's,
Mhm.
it can be a problem.
Yeah, don't get me wrong. I still want to be involved in these things. I just think some of the names are stretched, so you just have to be careful which ones you want. And I
Right.
think if you,
Yeah,
and
so
I'm
you have
talking
to
when I'm,
differentiate between the Max 7
Yes,
and
there's-
the big AI hyperscalers and all of that. You cannot treat them all the same. That's
100%, and then it's like,
moral of the
okay,
story.
so when you're, when you're managing portfolios, you're looking at 6-12 months, how these stocks, do they still fit in your portfolio? The answer for the most part is yes. I just think in probably the next few months, you're probably due for a slight, these
Yeah.
pullbacks. But again, I think the market continues to grind higher, and the Palantir, some of these valuations are, they're 25 times for way faster growth than the overall market's trading at 21, 22, 23 times forward PE multiples. So it's when you do I'm kind of a GARP guy, the growth at a reasonable price. When you start, take your PE divided by your growth rate, they're not that expensive as a whole. But it's not, at some point in time, they need to see more revenue leverage than their CapEx.
And because you mentioned Palantir, which reported yesterday, and they knocked it out of the ballpark as well, raised guidance, but the stock fell. So did the market, because there was a larger tech little jump scare because of Palantir, and also maybe these kind of Hong Kong summit, Wall Street CEO mentions have had something to do with it, because there was a lot of news coverage on that. It's like, are we really kind of over the top on valuations and all of that? But I think to both of your points, like how investors are reacting to these earnings, they're not just throwing money out there. They're very selective, or getting very selective, which means they're still reasonable behind, in their thinking. But
there's a lot of stuff going on, right? I mean, there's shutdowns. It's hard to. That's from an investment standpoint, it's hard to always pick one. Event that we, if I had to pick one thing, I'd always watch earnings. But there's a shutdown going on. There's comments coming out of different countries and things like that. There was an election that some people were maybe nervous, not nervous about. There's just a lot of always on a daily basis. It's hard to.
When I think the macro backdrop, we talked about this last week. The labor picture too, I think is real. That ticks and ties with the AI development, right? You're seeing hundreds of thousands of layoffs cumulatively now, since the beginning of the year. And a lot of it is kind of this white collar, labor squishiness, where you're getting this development where you're not getting kind of college grads to come in for an entry level position, because they're getting automated away using agentic AI. And I was reading through earnings calls yesterday, and there's probably 20 or 30 companies that explicitly called that dynamic out throughout this earnings season, where they're saying, hey, it's not just tech companies. It's like Ecolab and like Caterpillar, and like it's
Caterpillar was a huge winner.
Yeah. So I mean, you look at it and you're like, oh, like this is
it's spreading. And,
this is this is not high tech oriented. This is applications across the board.
Yeah, no, it's...
And we do not hear that very often yet, right? Because we still hear a lot, it's just a Mac 7 names, just a big cap tech, just a hyperscalers who are benefiting from that. Not, I mean, investors have different opinions on what benefiting is. Some of them already see some returns, some of them not. But it's already spreading into other areas.
Yeah, it's the second and third derivative.
Yeah,
right?
Yeah, exactly. And we do not hear a whole lot about that out there.
Right.
That it's already kind of flowing into others, which can help broaden the market as well.
And you'll see it, as it continues to trickle into companies that are more kind of employee intense in terms of like company like Disney would be a great example. You've got hundreds of thousands of employees, and if you can automate away some of those using technology, which I'm sure they will do, then it'll be a couple quarters worth, and you'll start to see that in the margin expansion. And, I mean, there's puts and takes to that dynamic for sure, but it's happening.
Mm-hmm.
Yeah, I think in any of those large companies, there's that optionality of being a little more efficient, and sometimes labor gets maybe displaced or even just rearranged maybe to a different area, right? So it's that, and just think of insurance companies, how much stuff that's it's manually done that maybe someone could spend time, more effectively doing something else that AI can handle.
Or like even the more technical aspects of an insurer, the actuaries, right? Do you need to hire people that go through actuarial exams that take 6 years of education or whatever it is?
Big brain powers.
Big brain power, big salary.
Which is what AI can do, right? So
right.
I mean, some jobs we talked about in the past, you want to, certainly if you're a young college student, if anybody's listening, make sure you're...
I mean, it's tough though, right? Because the last decades it was said, hey, get your college degree, work really hard, spend a lot of money on that education, and you will have a safe job and you will have a good career. And all these kids are now coming out of college, and not only the kids, also the older ones, right? Like us that are in the workforce already.
Older like me,
No,
Lisa?
yeah, no,
You're
not
still
me.
a kid at heart.
Yeah. It's like the one that's closer to his end of his career.
No, no. But the ones that are in the workforce already a couple of years, but especially college kids, kind of they spend a lot of money. They're ready to take on the world, right? Did what they were told to do, like spend time and money on education and really dig into that. And now they are the ones who get replaced, right? And
Well-
it was always the thinking, hey, if you're in software and tech or whatever, you never get replaced. Your job is safe and everything and do that. And those are the ones actually now that are getting replaced, not the blue collar, right? Because when you do something manual labor with your hands and blue collar jobs, they're all safe so far, at least.
Well, maybe
the
this is
majority.
a cultural flashpoint where, because the cost of education is
Outrageous, yeah.
outrageous. It continues to climb and climb and climb, and you've got this AI displacement. Maybe, and we talked about this. I think it was 6 months ago, or 5, whenever the interns were in.
Yeah.
We talked about the computer science degrees are the number one unemployed
Yeah.
out of like the
amazing
unemployment
for-
rate is the
yeah.
highest for computer science degrees now versus 3 years ago. They were the hottest in demand.
Yeah.
Yeah, for decades.
Right.
Yeah.
So maybe now what you'll see is an actual shift to technical schools and
More
entrepreneurship and
practical, yeah.
like people starting
That- I think
HVAC
that's
company and
Real. I think
Yeah.
in 10 years from now, we'll look back and say, that AI did really change the dynamic
Yeah.
of.
Yeah. I mean,
what
it's
was-
tough for, a couple of classes that are coming out and kind of a generation that is basically did what they were told to, and now
Yeah,
it's
I mean,
yeah, I mean,
they'll figure it out over time.
yeah,
It's just,
yeah.
everybody
It's
does.
just tough
it's just,
for
just
as
a-
the
There'll be a transition,
first
though. It's
impact.
certain.
Yeah, yeah.
Because it's
Definitely.
been, 2 decades you're told to do that, and 3
This
decades
is the
or
hottest
whatever.
thing you have to do, so you have a secure career, and then all of a sudden it's changed quite
But I
fast.
mean, the topic of AI, that touches, to Kyle's point, touches in everything. Like, even if you're a blue collar worker, I'm sure there'll be some, basically machine learning of how to fix an HVAC thing more efficiently and
Yeah.
save time. So it's actually going to help them do their job as well. You probably won't have a robot coming to your house to fix your plumbing. or your
on that point,
electrical.
actually, I wrote a piece last year at my old stomping grounds.
Oh, we're going to have to pull it out, Lisa.
Yeah, on augmented reality. And so, a decade ago, when I was at Oppenheimer Funds, I did a field trip over to Newport News where they build the aircraft carriers.
Yeah. Oh, that'd
And
be neat.
it was awesome. So they build the ballistic submarines and aircraft carriers. And one of the things that they showed me is, because there's labor issues, it's like basically like building big modules that they assemble at the last minute.
Big Lego system.
Big Lego system, right? But once it's put together, if you have an aircraft carrier, it's like you have to have the technical schematics to go in there, and you have to pay the people, the engineers and stuff, to be like, oh, we actually need to have wiring and plumbing and all this stuff that goes throughout the ship. And once it's together, you can't see those things typically because they're in
Just like a house, right?
right, just like a house. So what they said is, to save labor costs, they could actually use the Microsoft HoloLens at that point. And this was 10 years ago, where they have the glasses that look just like regular glasses. And then you can have an untrained person like me look at the wall, and it has the schematic literally overlaid. So you can see the real room that you're in.
Yeah.
And then you can say, I need to add this door here or whatever, avoid this area because there's high powered electrical cables or plumbing through there. So it's the efficiency that you can build into real world trades is, I think we're just at the beginning of that dynamic happening.
Yeah, no, I think that's exciting for that. So that could make that blue collar kind of tech merge that would be exciting for a lot of people. Distracting you, Lisa, sorry.
No worries. But I want to go back to answer, or to dig a little bit more into it, if we are, because we talked about earnings and all of that, and investors still seem to be reasonable, which is good, and then displacement of jobs and all of that. But I want to touch more on if we think we are there yet, and we are really in a bubble at the moment. And the interesting thing, though, is, right, we do not know until it busts, right? So no one really, despite all the metrics like the Schiller P, the buffer metric, like all of that is coming out lately. Again, it's the highest since the dot-com bubble and whatnot. But all of these different things do not give us certainty if it's a bubble or not. The certainty is when we have the pop, so to speak. So do you see that in today's market? And it doesn't also mean just we are in a bubble that this, needs to end to today or tomorrow. It can be a bubble for, extended period of time. Valuations can be extended for a longer period of time, right? That doesn't have to change overnight. But do you think we are seeing signs, or we are already in one? Or do you think it's still all good? Keith, I start with you.
Sure. I'll give a simple answer up front and say I don't think we're in a bubble, but I think certain parts of the stock market are getting a little inflated. So by not being a bubble, I don't think there's this big pop like, I've been doing this a long time. It was in 2000, it was just everything was getting thrown at it. Companies, we talked about this the last couple of times, weren't profitable, didn't have much for revenue. So that's why.
But still, there was money thrown at it.
Yeah,
which we don't
and
see today.
valuations were just crazy. Cisco's trading at 200 times PE multiples, and now there's that Palantir. There's one or two names I think that are extended, that are bubble-like, that need to be deflated some. But as a whole,
these companies, to begin with, are completely different than back then.
Yeah,
right?
and then I would say the financial crisis was kind of another. Those are the two massive ones. I don't think we're anything like that at this point in time. Now we could have runaway performance, and then all of a sudden valuations get super extended, cash flows come down, earnings come down, and there's a disconnect. I think right now they're generally going in the same direction. It's just a matter of maybe a little bit ahead of ourselves. So maybe we need to, just let a little air out. But I still think fundamentals are in place for the markets to kind of grind into year end, and then I think next year we kind of get that. We always like to throw our predictions, or some of us do, is again, for whatever those are worth, I think you get that normalized return, that fundamentals are still in place for your 8 to 10, 12% returns. So I think I don't think we're in that bubble. All of a sudden the NASDAQ was down 80%, right, when it popped. I don't see that for valuations at 25 times down 80% if earnings, unless they completely collapse. I don't think it's going to happen. So that's my thoughts.
Yeah, I would ride Keith's coattails there. I think the major there's definitely some companies that are stretched and they need to deflate a little bit, and I think that's just the velocity of money that is in the system at this point, and also structurally, beat the drum on this again, the retail money in the space is very different than it ever has been before. So I definitely think that adds to some of the kind of gamification of this.
The FOMO.
Right, the FOMO. That being said, you look at earnings. I mean, earnings are effectively what drive the markets. By and large, there's other factors as well, but that's a key one. And you look at this earnings season, you look at it, the last couple earnings seasons, and we're 80% of the way through earnings now, and the average EPS growth of that 80% block that's reported so far is up like 12.4%, and the expectations were up 8.2 or something like that. So you're a standard deviation higher than expectations. So that being said, companies that beat and raise, we saw Palantir yesterday, they're not, it's price for perfection. So I think there's a asymmetric risk profile right now where it's way more skewed to the downside. I think people just need to be careful and diversify, and use people like Keith and me and you to keep them on the straight and narrow, and work with their advisors to temper some of the behavioral dynamics that definitely will be coming. Because if Morgan Stanley or Goldman or JP Morgan or whoever are correct, and we see a 20% drawdown, which is, to Keith's point, normal, every few years, I think I think people are going to get squirrely, and you will see with how much money is in the system. I could definitely see it accelerating that in an unusual way, just because of the way that it is now structurally.
And you mentioned that with the change and the more retail investors are coming in, right, since 2020, especially since COVID. And we're also responsible in part of that sharp recovery in March 2020. Then again, this year, what we saw, right, one of the sharpest recoveries in history after 19% drop, that was hugely retail investors and not institutional money. Do you think, because a lot of these investors are younger, just entered during COVID, they never really had a bubble before, never really saw a bubble before or experienced one, and they are just used to sharp recoveries, right? That's what they did since 2020. It worked out perfectly for them. So do you think, and to your point, Cal, that changes the game a little bit? Do you think even if it's, so to speak, AI bubble and we see a sharper drawdown, do you think they jump in because they change the game and just help us with the recovery a little bit faster than it would normally be?
Yeah, I mean, you could spend a whole podcast at plus some on that. I mean, it honestly makes me think about like the introduction of the Fed and what they do, like how they changed the market dynamics in terms of quantitative easing and policy rates and all that kind of stuff, because the whole idea of that is to temper the volatility, the magnitude of the swings in the economy and the markets. And if you have this kind of Wild West dynamic, there are circuit breakers in the markets and there's structure that's there. But I think adding that additional dynamic on top of quantitative investment, always on, apps in your pocket, overnight trading, the dynamic of these independent individuals that are trading using social media as a mechanism to coordinate, I think that actually accelerates the recovery and the downturn in tandem. So I think you see sharper moves down, and I also think you see a faster correction on the way. It's almost like a stripping of that ballast or keel in a boat. You know, there's a lot more volatility, but it works itself out much quicker than a prolonged downturn.
And one last question. We probably can spend a lot of time on that as well, but I just wanted to get that in. Is there, because when we talk about bubbles and, you know, the .com tech bubble or now air bubble, if we are in one or not, and again, opinions do differ very much at this point. And we always hear, oh, that's bad, and it pops, and then a lot of money will be lost, and then, you know, valuations are reset, expectations are reset, and then we slowly recover back, but it's generally bad. But do you feel like, does it have to be that way? Or can it be that it comes slowly down without the big pop, without the big bad drawdown? So kind of the bubble deflates slowly and gradually instead of just a pop. And we saw that with gold, for example, right? Late 70s when they kind of when gold hit record highs, and then over the last 30 years, well, it's pretty much one straight line down, but very gradually, right? It was not the typical bubble burst. Sorry, Keith.
I like I said, I don't think we're necessarily in a full blown market bubble. So to your point, I think we can get a slow drawdown if we letting air out of some stocks. I would leave it at that and just kind of say that's where we're at. And I think I'm not, in 2000, it was just palpable that the feeling of chase performance, fear of missing out. It's like you'd go to a hotel or a cab and you'd have people just talking about stocks and these things that no one knew anything about, and just it was crazy. And I don't think we're there yet. I mean, there's AI talk, because I think it's literally going to be 10 years from now. Like, AI was real. It may not play out exactly how a lot of people think, but it's definitely going to change a lot of things.
So you think we can, if we're in a bubble or not, I mean, we
Yeah, I
don't
think we
think
can-
so, but generally, apart from that,
Yeah, I don't see a
bubbles
popping
can
anytime.
deflate
Yeah, I don't see
slowly.
a
It
big
does not
like
have to be
market
the big.
correction
Yeah.
based on a bubble popping
Yeah.
in the near future.
Yeah.
Put it that way.
Kyle,
Mhm.
one last word on that.
Yeah, no, I agree. To your comment on gold, I did look this up last time, and I thought it was interesting because people just talk about bubbles. But yeah, there was the Tokyo real estate market, which was a bubble with the same scale as the tech bubble in 2001, and that happened in the 90s in Japan. That reached its peak. It didn't pop.
Mm-hmm.
It slowly deflated over the last 30 years. So very much like the gold dynamic. And then also during the tech crisis in 2001, when that bubble popped in the traditional public markets, the secondaries market also experienced the same bubble dynamic, but it slowly deflated over the course of 15 years through, the mid-teens. So possible for sure. I think it's a lot more exciting to talk about a bubble blowing
That's
up.
what I wanted to
Yeah.
say, right? We do not hear about bubbles slowly deflating, because that doesn't make the news, right?
Right.
That's not exciting,
Right, it's not
Yeah.
exciting.
Yeah.
Right.
Yeah.
Which is good.
Yeah.
Right.
Right.
We like non-exciting
Right.
with that.
Yeah.
Well, let's end it on that. That was a good episode on all the bubble talk.
Are you going to
and
drop a
everything.
hint for next week?
So yeah, we could actually, because we still have to talk a lot about AI circularity. The
Yeah,
big
that's a good
boys
topic.
basically throw back and forth the money with each other.
Mm-hmm.
So what that has to do with all, and it kind of feeds a little bit maybe into the AI bubble as well. We do not have time today, but again, that will be a good episode next week then to talk about that, and it will perfectly feed into or be the extension of this week's episode. So all of you stay tuned for next week. We will keep on marching the same direction and be back and hit the like and subscribe. Until then, take care.